You with us, Kelvin?
Yes, I'm here.
How's the weather in Sydney?
Melbourne is a little bit overcast.
Yeah, and good trip over?
Yeah, no, it's good, thanks.
Good on you. We're just waiting for an Alyssa, actually. And then we're all set to go. Kelvin's on our line, not visually, but it was Denise that went to Sydney, wasn't it?
Yeah, Denise went to Sydney.
Naomi.
The order. Welcome to our special purpose to we made it to delivery of our annual report for June 2022, 30 June 2022. And special welcome to our auditors, Audit New Zealand. Julian, thank you for attending. So I caught up with Kelvin late last week, so I think our plan of attack to move this through as effectively, efficiently as we can within the hour that we've got is that Kelvin's going to kind of almost present section by section. And I think, Kelvin, we didn't actually articulate how we'd take questions, but I think off memory it worked pretty well last year where maybe we did pause at the end of each section to take questions.
Yeah, that's fine.
Yep. And then Julian, will you speak? Are you happy to speak post us going through that, or there may be some questions obviously for you as well as we move through it? Right, I'll hand it to you then, Kelvin. Thank you.
Thank you, and good afternoon, everyone. So we've got the 2022 financial statements, slightly later than what they would normally be, but we have been facing the constraints still of the continuation of a shortage of auditors, which has been challenging for the Audit New Zealand team, and I thank them for the hard work that they've done through this process. So I'll just start with a bit of a summary of the of where the report is at. So the report that's sitting in front of you today, and which will go to the council on Wednesday, is in the non-printer proof version. So what will come about post then is a piece that has a lot more gloss around it and pictures and illustrations, but the content of what is here today is what will go into it. So pleasure to signal that the group had a surplus of 99.2 million, which was 46.8 million better than the budget. and 56.9 better than the budget from a council point of view. So the group includes the CORD contribution and our other CCOs. The material variances from a revenue point of view come in the form of development contributions. So they're 24.7 million above the budget. And remembering that capital contribution or the development contributions are amounts which go towards capital investment either in the future or in the past to support growth in the district. So the expenditure will flow through the balance sheet as opposed to the financial performance. Vested assets is another large number above the budgeted number. It's around about 11.3 million. And again, these are assets which are constructed by developers which are handed across to the council, and we reflect the revenue or the valuation of those assets in the financial performance. They're a non-cash item. Some other items of note are higher than budgeted. Waka Kotahi contributions, reflecting what we're investing in our roading network. And we had a strong performance from CORD, who returned a dividend 0.8 of a million greater than budget. Now, if we move across into the financial statements, and on page number, just bear with me, it'll be the middle of the pack as I'm finding that. We'll just discuss the benchmark, and it's a pleasure that probably the first time since I've been here that we've managed to have all our financial benchmarks ahead of target. The one that typically does not have ahead of target is their balance benchmark, which is reflecting the fact that we don't fund our depreciation on the most part. So therefore, we have been fortunate enough to meet it this time around. I'm just struggling to get to the financial statements, sorry. Just bear with me. If we turn to page number 61 of your pack, and go to the statement of comprehensive revenue and expense, and we'll start from there with the financial statements. We've covered off most of the key items that are there around movements in revenue and expenditure. If we move across the page to the balance sheet, three key numbers I want to draw your attention to here. The first one being property and plant and equipment, a large increase there from budget and from last year. It's moved 659 million in the year from where we were at the same time last year. The predominant amount of growth there has come through the valuation of our water assets and other assets. And moving down the page into our liabilities and borrowings, we have gross borrowings of 75 million in the year, and that is up 15 million on last year, but significantly lower than where we had planned. And that's a combination of development contributions coming in higher than anticipated, and secondly, lower capital spend than budgeted. We'll move through the next page and then on one further to the cash flow. There's nothing really of note to address there. And likewise, second page of the cash flow. We've got this statement of accounting policies, which we'll just move through. And just to note, as we go through, the key policies related to the notes are now sitting within the notes, which makes it a lot easier for the reader of the financial statements to understand where things are coming from. The next page is page 69, which is a summary of revenue and expenditure. This is just broken down into our activity areas, just to show the revenue in a different form, plus also showing the rates separated there, which is slightly higher than where we had budgeted, and the large part of that comes from growth. And clearly you can see there also in the middle of the page, the vested asset number of close to 50 million, which is somewhat positive ahead of the budgeted number, just signifying growth. We'll move through further into the revenue, and you can see here a breakdown of the rates on page 72. Nothing really to note on that other than it's higher than budget. Moving down to the bottom of that page, the rates for emissions fairly similar to the position where we were last year, and we wouldn't expect that to change too much given the amount of new organisations that potentially get the remission are very few and far between. Further on to revenue on page 73, and we've got a breakdown of fees and charges, and you can see the largest number here at the top of the page is building and resource management and policy charges, and that again reflects the fact that we are a growing district and continuing to see the growth in those items. Not too much else there to look at other than you know, Aquatic Centre is sitting consistent with last year, and most other numbers being consistent also. Down at the very bottom of the page, we've got a breakdown of subsidies and grants, and you can see there the largest part of that is our Waka Kotahi contributions and Three Waters Reform Grant, which came through. Following on to the next page, again, it's just really the key thing here is we've got the vested assets again, but the dividend revenue that we received, which was smack on plan. I'll just pause there, so if there's any questions around the revenue side of their financials.
Questions?
No, we'll move on.
I have one quick question from me, not so much the revenue, but up front in the first section of the report. Going back to that Waka Kotahi variance on budget, so the contribution by Waka Kotahi, but the question was, so 3.5 mil higher than budget, and it was partially offset by Waka Kotahi, and then there was an additional 1 mil. So why would we not have that in our budget from a roading perspective? I mean, not in the long-term plan, or is it because the work's been recognised kind of just in time, or is that why it's not in the budget?
A couple of things going on there. One of them is the fact that we've got additional maintenance, which has sort of popped up through the years, which yeah, is unexpected, and additionally the higher cost of roading maintenance at the moment.
Oh, right, okay. Yeah, no, thank you. I've got a few more things, but that kind of ties into some other stuff, so I'll let you keep going. No other questions for that first section? Right.
So I just feel a small bit, probably it might be, it's still in, yeah.
Oh, yeah.
You might have some, you might deal with it. Also, back from page 11, where we talked about the budget variances, and I'm just interested in your comment on some of the budget variances. Obviously, $56.9 million variance surplus is quite a lot on a budget that size. So, particularly around 3.7 million that were taken in various in rates and the development contributions and the other revenues. The other 3 years that I had a question on whether you had any thoughts or comments on that, whether it was conservative estimations, whether it was just growth or what it was.
Okay, largely growth. So on the rate side of things, 3.7 million up, that's largely a factor of the growth numbers. So we assumed that we would get X number of properties in, and it ended up being a larger number than we expected. So that was a positive. The other piece around growth is development contributions. So we've got that 24.7, and that's really a factor of timing when developers come on board to complete their developments and get their regulatory sign off, and probably balance that will all balance out over the long run of the plan, because what we're trying to do with development contributions is recover the cost of growth expenditure into the district with the development contributions coming through. And every 3 years, as we're renewing the policy, that sort of resets, recalibrates as we bring on new projects and adjusting for what has been already recovered through development contributions. And then the third area around other revenue, the largest piece on there is the vested assets, which are those assets which have been contributed by a developer. So we have a new subdivision, and there's some pipes roading, various things which have been created by the developer and then passed to the council for their our ongoing maintenance and ownership. And so that's valued at the point in time it transfers to the council, and we're reflecting the value into our statement of financial performance.
Thanks, Calvin. I'll move to the next section.
Okay, personnel costs. These are really required by the legislation or the accounting standards that we break out our salaries and wages and contributions to the likes of KiwiSaver. We have seen an increase in personnel costs at the council, and that's to be expected through a couple of things, being the annual increase in salaries and a growth in staff numbers, which you can see down there, which is broken down under the council employees at every band of salaries. We'll move across to the next page, and we've got a breakdown of the councillors' remuneration, is what it is, which moves us forward into other expenses. Again, the breakdown here shown on page 78 is driven by accounting standards largely as to certain things that we have to display, i.e. the auditor's fee, bad debts and others. So really not too much there to discuss. Operating lease as a leasee, we've got nothing there as a council, but we do within CORD. Finance costs slightly lower than where they were last year, and that's just really a fact of where the interest rates were at that point in time. But we know that the interest environment has changed substantially, so we'll be looking at a much larger number moving forward. Tax is really nothing to talk about from a council point of view, but there's a little bit more to discuss from a group point of view, where you've got CORD, which is a taxable entity. And we can see their tax expense just over 2 million for the year. Deferred tax, nothing to really discuss here. It's minor numbers. And I think we'll stop there, Annalisa. That's now heading into the balance sheet. So any questions on expenditure?
Any questions? Just a couple more questions from me. Apologies if it's not on expenditure, but it is the first half of the report. In the front section, which is almost the, so apologies, very front section, and it might be a lesson learned for next year, but we've got a great story to tell. And as I was saying in our pre-hurry with David, is that, the annual report is all about telling the reader a really good story of what, the success story of what we've done within the year, which I think when you read all 166 pages, it definitely does tell that story. But I found a little bit piecemeal, and I thought, actually, what a great opportunity. And I know we're very late in delivering this report, but of our major projects that we've delivered. So when I read the first cover, I might have been in your two, Sam and David's covering it, it kind of follows all of these great projects. And I was like, oh, that's it. I'm going to tell a big story, and actually almost coming back to that program benefits, what benefits have been realised. So yes, we've delivered the health centre or the sports facility, and we've had this many people through. And then when you get through the report, we've actually talked about how we had eco-green stuff to do with that particular building. So we could have almost, and again, maybe next year, is that, and maybe it's in your letter, it's actually have a whole page on one of those projects and actually put everything there, because it's almost like we talk about those projects all the way through the report. And I thought, when I first read it in the covering letter, I said, all you've said is that we've delivered this great project and we're really excited about it. And then you read another 40 pages down and go, oh, and actually this project was green rated, and then that's the Foster Park was in the football turf. So maybe again next year, but making sure we really celebrate and tell the good news around some of those projects and more the benefits of those. So we've talked about the cost, and we've talked about we've delivered it and it's on time, etc. But what have been the real benefits of that since? And maybe there hasn't been enough time yet. Maybe it's a good news story to tell next year, and we can say, look, we've had this many thousand people through the doors, or it's around telling the benefits, because we've talked about that within our audit and risk committee HUI around our internal reporting. So this is a great opportunity to actually why not tell our community around what these great benefits. Anyway, that's just a comment. So this was a question, page 17. So going back to page 17. So the planning for future growth, where there's a commentary August 2022, which is a variation to the district plan. So is that a subsequent, I know it's only commentary, but is that a subsequent event? Like, why are we telling that in this annual report when it relates to August 2022? I guess it's a proposed legislation change, isn't it? So it's not a change to any. So maybe it's an auditor question about me getting an understanding of the requirement to do so. But it doesn't impact any of our financials.
It does.
Oh, it does.
There's a significant amount of money that's spent. Well, I shouldn't say significant amount of money. There is money spent for doing hearings and all those sorts of things, actual processes of it.
Yeah.
There is actually one thing on that page. So I confirmed with Tim Harris and Robert Love is on that third paragraph. The last section, the last sentence on that says the proposed plan is expected to become operative soon after that, which refers to the date August 2023, and it's technically not quite right. It's actually got potentially appeals and other processes to go through. So I've got some different wording for that. But it's quite interesting reading the front of this, trying to get in your head. This finishes the middle of last year. And I struggled with parts of that, but I agree with what you've said about actually celebrating what we've done, because there was one page 14, and we've just highlighted a few of our services, but we've completely missed out like the Salmon Sports Centre, which is a good news story. I was saying we've set admissions to the Aquatic Centre and the Sports Centre. That was really new as well. And that's right, saying to the community how great this is. These facilities are being used and stuff like that. So I've gone through reading it, and there's just a few changes. I won't go through the changes that I've suggested of some of the things, but I will put it back to staff that maybe some of the things.
I think the project one is it's a good opportunity for next year, which is not that far away. It's only 6 months away. Is that because we would have, yes, we can celebrate the success we've actually reached practical completion and delivered this project, but hopefully by June 2023, we're actually going to have some data, some good data to be able to tell what the benefits of those assets have been. So maybe next year for counts we can.
It's only 3 months ago, not 6 months.
Yeah, it's only 3 months ago.
But
Exactly.
But I do think we sort of forget that this report finishes in June of last year.
Yeah.
And a lot of the things that you're talking about we did actually do. And so basic case would be Tiara Artia, where we've just done a huge promo around the fact that that's been open for 12 months. And we're focused on the numbers and we're focused on the benefits. And so, yeah, we are doing it, but good reminder.
Did you have anything else?
Yeah, no, that's what.
Also, again, just a timing thing, but I spoke to David about this, which was page 24 was around the Three Waters reform commentary, around the commentary that we made to the select committee. And I just wanted to make, but it is fairly clear because it says this is our view as at July 2022, because obviously our view as at today might not be, when you look at those 3 bullet points, might be slightly different, but I think that's clear enough with stating that that was our view at that time. Now this is a random question. Page 36. Canterbury Museum, it was more a classification of where this cost sits. And is that like a donation to their capital program of the Canterbury Museum refurb that they're doing? Of what we've made a donation of 2.3 mil, or
it's a legislative required. So there's the Canterbury Museum Act, I think it's called, where we're required to contribute to it.
So yeah, my question was just more about where it's sitting. So it's sitting under staff and supplies of democracy. Is that's the best place for it, or that's where it's meant to be for that kind of thing?
That's where it's budgeted to come from, out of the democracy budget.
Oh, right, okay, yeah, that makes sense. Yeah. Have you gone through accounting policies? You moved pretty quickly through those. I've got.
Yes.
Can you just give me a bit of clarity on, I guess, the short version? Hopefully I'll pick it up, but the difference between moving from IPS AS 29 to 41. Obviously, you've got the 3 bullet points on what the main key changes are, but has early adoption had an impact on our financials with regards to fair value? Because I think the commentary is that we have early adopted from 29 to 41, and the impact as those 3 things around fair value, earlier recognition of a loss, and a third one. So has it changed our numbers from in a good way or a bad way, if I keep it simple, from the prior period?
Well, it can't be a good way or a bad way. It's now reflecting the way we should be disclosing going forward. So it's just a different valuation process. This is sort of what is used in a more commonly across organisations in New Zealand now, as opposed to where the public sector sits a couple of years typically behind.
Yeah.
So really not a large impact because we don't have a lot of financial instruments.
Okay, so minimal impact because of the value of instruments that we've got. Yeah. And then I had again, small question, but just out of interest, the forestry assets, is there a price decrease? That's more my understanding. It wasn't a big number, but it was a comparison on the prior period it was, and I think it was there. It was a debit of 300. Is that the price has gone down rather than the actual quantum?
I'm just trying to find the note for forestry assets, which we haven't quite got to yet. 300,000 is related to price changes, and 24,000 is related to physical changes, and 13,000 due to purchases.
And my last one for this section of the contingent liability for the rugby club. So that's been there for a while, hasn't it?
Yeah, it has. Yep.
So at what point will we set to write that off? Or
I would need to look at the details of the agreement with them.
okay.
Yep.
That's all from me. Thank you for this section. Any other questions?
Okay, I think we jumped ahead a fair bit there with those, but we'll carry on from where we are with cash and equivalents, which is on page 83 of the pack. We're in a very similar position to where we were at the same point last year, and continuing to actively manage where our debt and our cash sits, so not to have too much excess cash just floating around bank accounts, not earning a lot. And especially now when we've got a higher interest rate environments, making the best use of that cash. Receivables, slightly higher receivable for rates. We are starting to see slightly more challenging environment with payments, but keeping on top of that with good debt management. We'll move through to page number a 6-year pack, which is talking about derivatives and financial instruments. And you can see the valuation of our swap book, which is not a large swap book, about 12 million sort of sitting in there. We'll skip through the next page, which shows it does show our low interest rates. Inventory and work in progress. We don't have a lot in there. Could have a lot more of this given they're constructing assets. The next section is a whole of policy on financial instruments, which we'll move across. And then we see on page 91 a breakdown of our financial assets, and within this you'll see that we've got term deposits and then our investments into our CCOs, with the largest of those being our share of Orion. Moving over to the next page, we can see there we've got some small loan balances sitting there which are decreasing, which you would expect. There's been nothing new added to those. Again, we at the bottom of the page, we've got our equity investments in CCOs and the local government funding agency, which is a result of our borrowing, where we end up having some ownership in it. If we move across the page, further on to page number 94, and we can see there a breakdown of our investments in associates. Nothing too much to see there. Investment property, and we've got some items here where we've got additions through the year, and we've got some transfers out of property, plant and equipment into the investment category. And this will happen from time to time, where we reallocate what a holding in land may be, where we may be holding it for a strategic purpose, which we held in property, plant and equipment, to a point where we go, we no longer need this for strategic purposes, and we'll move it through to our investment portfolio. And as councillors, we're aware the review we're doing under property will potentially have a further impact upon this in the next year or two. Property, plant and equipment, we'll skip through all the policies there and the depreciation rates. And we'll get to the, eventually, we'll get to the statement on page 102, which shows where our property and plant equipment is set within the categories, and quite a substantial holding that we do have in assets. And a lot of valuation movements impacting these numbers. We'll just move through those, and we'll get to page 106, which looks at our capital commitments. What a capital commitment is where we've committed to spend a certain amount of capital, and it's contracted. So as opposed to it being budget, we've actually got a signed and sealed contract with a vendor to supply it, and therefore we've got a commitment which will realise over future years. Insurance of our assets, there's a summary there of insurance and how that's broken down, and the next Audit and Risk Committee will have a presentation from our insurers on the next year's program. Intangible assets, which are typically our software assets, and you can see there the balance is sitting there. Software and will typically be amortized at a reasonably quick rate, reflective of the lifetime of a license, but they're normally shorter term than what you'd see with a large infrastructure asset. Forestry assets, which we've just covered off before in the question, and you can see there the breakdown at the bottom of page 111 in diligent, which is the balances of forestry. You can see they've decreased by 300,000 relating to that price change, but we've had a couple of smaller increases around purchases and changes to physical changes. Payables and deferred revenue. So this is at balance date what we owe to creditors. We've got our retentions amounts in there also, and some amounts owed to Cord and other associates. We might just pause there because that's a sort of a nice ending to that before we get into employee entitlements. So any questions?
Questions?
Yes, might be a silly question, but on page 95, so breakdown of investment property and further information. How come the group is council plus CORD? Is that right or not?
Yes.
So how come some of them that the balance for the council is higher than what it is for the group?
That will be because we've got investment property which CORD use, being their office. And
So we're leasing it back to them. Okay, so that makes sense. Otherwise, I was just unsure. Thank you.
Yeah, no, consolidations create confusion.
Yeah, no other questions?
Okay, employee entitlements. Again, these are a breakdown of where we are with our leave provisions, and you can see the largest provision sits within our annual leave provision, and we're always trying to keep this as low as possible, and the reason for that is that provision will grow naturally as employees' REM increases. So we're trying to make sure that people take their leave at the appropriate time to not grow that balance, but more importantly, they're taking their leave for health and safety and wellbeing reasons. We move across to provisions. Again, we have provisions held for landfills where we potentially have costs that we'll need to pay into at a later date to have landfills dealt with in the appropriate ways. Borrowings, as I said before, 75 million compared with 60 million last year. So we've seen an increase that was a lot lower than what we planned for. And there's a breakdown of our facilities and overdraft capability. The next page, we can see movements in our borrowings and with the specific loan reserve accounts that we have. Construction contracts, again, this is a group number because largely sits with CORD, nothing with council. And this is where the retentions are receivable and payable and various aspects of contracts. Contingencies, we'll just slowly work through these a little bit. So we have the Building Act claims. So we're focused upon potential risks we have there, and we have allowed for an amount around weather tightness, which is decreasing, has been decreasing over time as those have come through. Local government funding agency, and this is to reflect our shareholding in the local government funding agency and potential risk that does come with that. Landfills, as we've noted, there's always risk within those. And CORD, from a group point of view, have retentions to third parties. Very small contingent asset sitting in there from Kotahi from a prior period. Equity, really this is just some summary of our equity positions, which are generated through surpluses and reserve movements. We'll move through those, and then a breakdown into each of our reserve accounts, which I won't go into any detail on those, which will bring us through to related party transactions. And this is really just a breakdown to make sure that we're reflecting that what is going on between our charitable trusts and CCOs, and also the key management and personnel remuneration sitting within that. And then we've got post-balance sheet events, which has 3 waters and a piece around uncertainty relating to the residual impacts of COVID-19 and the conflict in the Ukraine. Financial instruments, and we have a note here discussing the breakdown, the early adoption of PBE IPS AS 41, which is some technical accounting elements. And we go through the fair value requirements of our notes, which again, very technical, and happy to take questions on those ones at the end. And then we run through the variances to budget, which we've already discussed early on in the report. And a note around the statutory deadline, which we haven't met for the reasons outlined at the start of this meeting, which is around auditor search shortages and challenges we've had there. We followed at the end with other legislative disclosures, which is our funding impact statement and a breakdown of our financial interests. And finally, through the tail of the report, we've got the CCO's performance against their statement of intents. Which brings the end to the financial statements. So happy to take questions before we hand over to Julian and Payman to discuss the audit.
Any questions?
Yeah.
Yeah. I did, there's only one commentary, and it was more, I mean, we've kind of run out of time, but again, it just comes back to the lateness of delivering this report. That when we talk about, it's only in a few places through the report, but it talks about, you know, within the year, and it might be useful to actually have the month and the date, like, you know, May 2022, because when you go within the year, people, you know, if you're a fresh reader and not understanding the world of audit, you go, oh, yeah, that's within not 18 months, because it could actually be 18 months ago, couldn't it? So it was more on the up, I think the front section where like we're talking about the delivery of projects or something, we go, oh, within the year or within the, you see actually going in April, and a small thing. And then the other, again, just around timing, just making sure, and in most cases, I think where the note has referred, the notes are really good, but where the note has referred to timing, maybe just making sure that it's not a material balance. And if it is a material balance due to timing, then maybe, I guess, review the value of adding, you know, the value or why it is actually timing. So whether it was, you know, brackets, because 80% of the value didn't come through to the next period. But I think in most cases, the timing is not material. It's only a smaller balance. I think we've raised that within the Audit and Risk Committee as well. Just be careful of using that as it's never an excuse. It is always the reason, but just be careful that it's not a blanket, you know, it's because of the variance, it's because of timing. If it is, then tell us a little bit more if we need to. But no, nothing more from me. So
I'm just addressing that point within the year. Yeah. Remember that a lot of people might pick these up in a year's time and read them, and when this was delivered is irrelevant, because you're always reading this report on the basis that the year ended 30 June 2022. So yes, the audit and delivery of these are late, but it's only that point in time where that stuff sort of makes an impact.
Yeah, I guess the reader just needs to remind themselves that we are reading the reports as at 30 June from.
That's what you do when you read e-finance.
Yeah, and we won't be any, you know, we won't be different to any other organisation, you know, in the audit in this kind of 2-3 year period. People are, you know, lots of organisations are going to be reading reports that are late. But no more from me. Thank you, Julian.
Well, thank you for welcome, Elisa. We have reached a point where we are able to release the audit report on Wednesday, and we have in fact shared with the committee, and it's included in the council pack, the draft audit report for 2022. Has got a couple of additions which are not normally included, one of which relates to the 3 waters reform, the wording for which might well change to something more concise and affordable. Affordable is the word. And an explanation regarding the lateness in completing the audit. And we have provided a text for council to include in the note to the financial statements because of the auditor shortage. In leading to us being able to clear the audit, we have looked through the key audit areas which we mentioned in our audit plan. The most important ones were in regards to the revaluation of infrastructure assets And you'll see in the financial statements, there's been a tremendous uplift in carrying value as a result of the revaluation exercise, some of which have gone up by, costs have gone up by more than 100%. So the revaluation uplift in total arising from trade waters and roading is close to, in fact, it's over $500 million. So your balance sheet has increased substantially because of the cost increases in labor, in material, and so on and so forth. So it's a huge revaluation uplift, which in coming years will have an impact, and certainly just looking ahead to your LTP will have an impact on your depreciation calculation and rates setting impact. The other areas that we look at included work on consolidation. There's always an area that can present problems, and this year, perhaps because of the delay, we had a bit more time to look at it, devoting manager time more than anything else, looking at the elimination of inter-entity profit. So we did a bit more work. There's a portion that was not eliminated. It's not material to the financial statements, but it'll flow into your letter representation. I think it's about $1.1 million. The other work that we did, and which we signal in our audit plan to council, was about the implications of the restructure program. In dollar terms, they're not material, but in terms of the qualitative nature of the restructure, we look into compliance with accounting standards. This is about your KMP disclosures, and also about the compliance aspect with the Local Government Act. They're slightly different in terms of how you apply them. So we are satisfied that that's all properly accounted for. I think those are the main things we look at. I'm not sure if there's anyone else who want to raise their questions with us.
Any questions? No? I actually just had a question on the management rep header. That's right, just the three unadjusted items, two of them, one of them being timing, one of them being an error, quite immaterial, but the 1.1, which is quite small as well. But can you just explain that to me from is it an asset that's been created or made by Cord, and therefore
Yes,
there's a different
correct.
opinion on whether we can depreciate or
That's
not?
correct. That's correct. So there is information available such that we are able to tease out the proportion of profit in the asset built for council by Cord. So when you are reporting on a consolidated basis, you have to eliminate the profit element. Otherwise, you're double counting your asset value. So that's a consolidation adjustment only.
Yeah. And so, Calvin, what's our view on that? Is that was that a timing thing that we didn't do it at time and it's immaterial? So
No, I can explain that. It wasn't so much the timing; it was the previous method used was, in fact, it's still a current method. The council has used is a blanket adjustment using the Cord's gross margin for the whole company, whereas information should be obtained at the council Cord specific level for the contracts completed, because the margin for Cord's customers are not necessarily the same across all contracts, and because of the amount of additions done in 2022 was quite significant, the impact could potentially have been a lot larger if the margin differential was quite big.
okay, no, thank you. So if there are no other questions, with the understanding that there may need to be a note change, Julian, for,
Yes.
so
yes.
we need to wait for OAG to let us know what that note needs to be.
Yep.
But that will be before Wednesday.
It will be this afternoon. I think I
Okay.
saw an email which I read up earlier.
Julian, can I just seek clarification on that this is the government has made a change to their program as opposed to legislation still being through orders?
Yeah, it's the wording that the Auditor General's Office wanted to update. It's Three Waters was the week before, yes. Last week, it's now something else.
But the legislation is still 3 waters.
No, we have to look at what the intent is by government.
It's just the note, right?
So Julian, just go over the wording that you're proposing to change.
It's not me. I mean, it will be the Auditor General's Office.
Sorry, not you personally, the collective view.
I mean, I can't see anything that might give cause to concern about political bias, but that's something else. I mean, those words will come, and I will just share them with you, and those will be the words that will be built into our audit report. That's it.
Okay, so for clarity, it's in your audit report as opposed to what we've got in there.
No, it's the report as well.
Well, I mean, the easiest way is to practice it somewhere by a footnote, a font size that is hard to read, to say something about the announcement made by the government last week.
The impact would be
So-
up to 28, if any.
If any, yeah.
So my question, Julian, is that can I today recommend that this Audit and Risk Committee recommend to full council to adopt the accounts as they are?
There's just on the statutory deadline, there's a clumsy sentence in there which I might want to fix. You can read it for yourself. It's quite clear. It's a bit clumsy. It's our fault, I'm sure. We'll fix it. We give you the words. But in substance, minor changes are perfectly fine, even on the day. So there'll be a set of resolutions. The council consider the draft annual report, make whatever changes, like a missing typo, word here or there, and receive the draft tax management representation tax, approve it, and finally we will give you the report for adoption with the approved annual report.
Sure. So effectively, it's note 28 that we're talking about, isn't it?
31 in my version. So
No, you mean the two.
So the one called Three Waters Refinery.
3 waters, sorry.
Yeah.
Yeah.
No,
Yeah, we'll give you those words.
Okay, we can probably move. So if I can have someone please move that we make a recommendation to full council to adopt 30 June 2022 annual report with the appreciation understanding that there may be a tweak from OAG to the note.
Yep.
Note
28.
28. Oh, move. And second. All those in favour? Right. And do we need to do the same for the management rep letter? Don't need to, that's just part of the
Just for your information.
motion. For information. Okay.
So that's the that's the accounts.
Not the audit report, no, this is just the accounts.
Yep.
Yeah, There were no, yeah, there's no changes to the actual accounts requested. No. All right. Yeah.
So to dwell back on note 28, but I'm guessing the only change is the title of the note.
The commentary.
Well, the commentary doesn't refer to Three Waters at all.
Well, this commentary has come from OAG anyway, initially, hasn't it? So it's their wording to start with. So if they make changes to it, yeah, we just need to adopt it.
Yeah.
I'm uncertain what we need to change other than the title, which title 3 water reforms may be affordable water. And then it says in the last sentence, additional legislation is expected in 2023 that will provide detail on the transfer of the assets and liabilities to the water services entities.
So Julian, what by way of heads up can you give us in response to that? Okay. Okay. That's what we can do. Just leave it at that.
Yeah,
Yeah.
and that's mandated from OAG. It's not much.
Yeah.
So it's not going to put in a report.
9.5 months later.
Yeah, I could take the report.
Current.
Yes. We do it next time.
The reason is that we still haven't adopted, so we're still in that working to that prior period. Yeah.
Oh, we're closing enough already.
Yeah.
Unahia, te po, kia watia, e kua watia.
Kira.
Kia ora.
Cheers.